Welcome, folks. This is today's price action for gold. So at London Open, we had a sweep this low, and we also traded into this inefficiency right there. As you can see, we took out that low right there at exactly 230. We took out that low, and then we traded inside this fair value gap. So the drawn liquidity was this high, and maybe eventually this high. So we traded that, and then we took out that high at London Open. This was at 345. So we took that high right there, and then now we price sold off. So our targets from up here would have been these relative equal lows. We had this inefficiency, we had this order block, and eventually we had this inefficiency right there. So if we take our fib, anchor it from this low right there to that high, so using up to that high. So as you can see, this order block and this inefficiency was at discount, so it was wise enough for you to target those as your drawn liquidity. So you had these relative equals lows, where you could maybe have taken your partials and then going into break even and holding for price to hit your targets. So if we head over to the 1 minute chart, so this was it. So we had the sweep. You could have gone long right in this candle because the draws to the upside, but if you wanted to really be sure, so you had to wait for a shift in market structure. We had a fair value gap right there, so your entry would have been there, and then your stop would have been maybe below these lows. So your entry, and then your stop, and then now your target would have been these highs, and eventually we had this high. So that was the first trade during London Open. Then now we had this trade. So the way you could have traded this was to use this as a inversion fair value gap, because now the draws to the downside, because you have already taken buy side. So as you can see, as price was hitting this, we traded into this inefficiency right there. We went past it, and then as this candle was trading inside, as you can see, we traded into the midpoint of that inefficiency. So that could have been your entry. So your entry would have been, that would have been your entry, and your stop just above that high, and we could be aiming your first drawn liquidity would have been these lows. So that was a 7.74 R trade. So if you were to aim for that inefficiency, it would have been a 13.42 R trade. So that was it. So taking partials right below those lows, and then now placing a stop at break even or even better, and holding for that for price to play out. So we had that. So that was it. And here we also had these we could have used these as your entry, as price was hitting these inversion fair value gap, placing a stop just below that low, So it will look something like this. That, then stop be placed below that low, and then aim for those relative equal highs. And as you can see, that was a 6.12 per trade. So that was it for gold. It wasn't so hard to determine the drawn liquidity and your entries, and also being a bank holiday, there were still setups that were tradable. So I guess that's it for gold. And until I talk to you next time, be safe.